Get it. The noise is deafening right now. But while everyone is looking the other way, something very specific is starting to set up. Let's talk about 3 scenarios. Scenario 1, this is the short strike. This is kind of like the sequel to Operation Midnight Hammer. Cruise missiles, B-2s lifting off in the dark, precision hits on IRGC command nodes, and military infrastructure. In and out, surgical, loud for 72 hours, then it becomes leverage. Iran retaliates, but carefully, just enough to save face. A calibrated missile volley at a U.S. base in Qatar or Iraq. Remember that? Proxy rocket fire from Hezbollah remnants, symbolic, not suicidal. Nobody actually closes the Strait of Hormuz because that's the red line that neither side really wants to touch right now. Markets know this playbook. Oil jumps $8 to $15 overnight. S&P futures drop a couple percent before the open because that's what futures do when something explodes while you're sleeping. Let's be honest. Treasuries rally, gold pops, and then if the guns quiet down, the relief trade begins. By week 2, markets start clawing back every bit of those losses. Here's the ETF playbook for scenario 1. XLE, Energy Select Sector Spider, Exxon, Chevron, Conoco. These names move tightly with crude. ITA, that's iShares US Aerospace and Defense ETF. Lockheed, RTX, Northrop. The companies building the hardware in this particular type of drama. Then, of course, there's GLD, that's Spider Gold shares, the clean hedge when missiles start to fly. And yes, the buy the dip trade through SPY has historically worked in limited strikes, but timing really matters here. You got to exit energy and gold once the market price is in resolution. Discipline is not optional here. Remember that. Now, scenario 2, that's the multi-week conflict. This is where it gets a little bit uncomfortable. Iran doesn't blink after the first round. Naval forces begin harassing tankers near the Strait of Hormuz, not closing it though, but reminding everyone that they actually could. Here is a number worth knowing. Roughly 13 million barrels of oil per day moved through that strait last year. That is nearly a third of all global seaborne crude flows. You don't have to shut it down to cause serious trouble in the markets. Freight rates, of course, will surge. Oil doesn't just spike, it stays elevated. And when crude pushes toward 85, 90, $100 per barrel, something else starts to happen. Guess what that is? Inflation, which had been behaving. It starts acting up again. Remember in the last CPI print, energy was actually deflating. That tailwind completely disappears overnight. The Fed, which is already walking on a tightrope between a softer labor market and sticky prices, finds itself completely boxed in. Rate cut expectations get shoved further out on the horizon. And the rate-sensitive corners of the market, and guess what they are? Tech, real estate, and your high-growth favorites. Well, guess what? They take it on the chin. Broad indexes could correct high single to low double digits in that environment. That's not fear mongering. That is really just math. In the multi-week scenario, XLE and ITA still make sense, but now you layer in a little bit of TIP. That's Treasury inflation protected securities as a direct inflation hedge. You rotate away from growth heavy exposure a little bit toward VYM, and that's the Vanguard high dividend yield ETF. That's got healthcare, consumer staples, and financials. Cash generating sectors that don't need cheap capital to survive. And you keep a close eye on your tech weighting, please. If you're already heavy there, you know what you need to do. Scenario 3, that's the multi-month regional conflict. This is tail risk. Most analysts put it somewhere between 10% to 15%, low enough to tempt complacency, high enough that ignoring it would be kind of foolish. This is the version where Iran activates its full network. Hezbollah remnants in Lebanon, Houthi drones out of Yemen, militia rockets from Iraq, and Iran simultaneously threatens the Strait of Hormuz with anti-ship missiles or more mines. Saudi and UAE energy infrastructure could also become fair game in this scenario. At that point, you're not talking about a temporary oil spike. You're talking about a core supply shock. Oil north of $100 is not out of the question at all. And suddenly, a word that most of my viewers under 45 had only read about in textbooks enters the chat. And that word is stagflation. In a genuine stagflation environment, the nastiest drawdowns hit consumer discretionary, tech, and anything that depends on cheap capital. The portfolio posture shifts from opportunistic to defensive. GLD is no longer a quick trade. It's a longer hold position. ITA stays because a regional war is effectively a defense contractor backlog machine. TIP remains in place. If you want more direct crude exposure, you can go to USO on the table, but it is volatile and not for the faint of heart. In this scenario, capital preservation outranks return maximization. Here is how I think about the probabilities. Short strike, 55 to 60%, most historically precedented. It aligns with the administration's preference for precision pressure as a negotiating tool. Multi-week conflict, that's more like 25 or 30%, dependent on miscalculations or political escalation on either side. A multi-month regional war, 10% to 15% tail risk. This is not your base case, but it's not zero. And I want to leave you with this. In the 1983 film War Games, the Whopper supercomputer, remember that? It ran thousands of nuclear simulations and eventually reached the one conclusion, which is the only winning move is not to play the game. Markets, thankfully, are not thermonuclear chess. They're not zero sum. The S&P has recovered from every geopolitical shock it has ever faced. Think about Korea, Vietnam, 9/11, Iraq, last summer's Iran strikes. The investors who do best in these scenarios are not the one who panic sell into the red headlines. They're the ones who think through the scenarios calmly, position thoughtfully, and execute with discipline. You don't need perfect foresight. You need preparation so that when the phone rings, metaphorically speaking, of course, you already know your next move. So your truth bomb for today is this. When two carriers point at the same country and Polymarket says 62%, the only wrong move is pretending it isn't happening. Join me every day for Wall Street Truth Bombs, where I drop them right here before the market figures them out.